hold on. We get started. So again, thank you for joining the webinar tonight. This is part 2 of venture capital, how to prepare your startup for venture capital. My name is Roger Royce. I am a partner with the international law firm of Haynes & Boone. I'm resident in the Palo Alto office. And thank you for tuning in. So if you were here with us last month, it's been a couple of weeks now, you would have heard part 1 of preparing your startup for venture capital, where we went through really all the things you need to do before you even get to term sheet stage to make sure that you're a candidate for venture capital, that venture is right for you, that you're right for venture capital. Right, I'm for love, but love might not be for me. So we got to make sure it's a two-way street here. Tonight, we're going to talk about what to do when you know that you're going out to seek venture, how to deal with the venture capitalists, and we're going to spend a lot of time on the term sheet, the terms that you should expect. Now, you'll notice on your screen, you have a couple of things. You have a chat box. If there's something wrong that I need to know about right away, like you can't hear me, you can't see me, you'd rather not see me, whatever it is, use that chat box and let me know. If you have a question about what I'm talking about, type it in the Q&A box. I'm going to get to that at the end of the program, and we'll go through your questions. I see people are still joining. We've got a real good audience. It's an international audience from all around the world. I am coming to you from the heart of Silicon Valley, where it is in the mid-90s and nobody in Northern California has air conditioning. So you might notice that here. Fortunately, hopefully you're in a warmer or a cooler place than I am. All right, well, why don't we get started? So I am going to, okay, give me a second here. I'm going to share my screen with you. And I'm going to start a slideshow. And you should see my slides. So if you don't, hold on here. If you don't, send me a chat or send me a text or send me a message. So how to prepare for venture capital funding, part 2, venture capital terms. Okay, I don't see any complaints by chat, so we must be doing well. To start off, just to let you know, I'm a lawyer. I'm not your lawyer, at least not yet, or at least not with respect to anything I'm going to tell you tonight. I'm going to give you kind of broad, general rules, guidelines, advice, wisdom about venture capital generally. Okay, hold on. Somebody's raising a hand here. Okay, great. You can see and hear me. Thank you for that. Save your other questions for the Q&A box. Yes, these slides will be available, and my slides from last week are available. Just shoot me an email. Happy to share all this with you as well as all of my materials. Okay, so let's jump right into it. So again, we're going to focus not so much on angels. We're not going to focus on friends and family. We did all that. We're not going to do crowdfunding. We're not going to do ICOs or tokens or SBA loans or paycheck protection loans or anything like that. We're talking about venture capital tonight. So this is a whole new ball game from any other financing that you might have raised, whether it be bank financing or your rich uncle or anything like that. So hang on. Again, I went through this last week, but I do want to remind people that this is a tremendous amount of money that we're talking about in venture capital. And here are some numbers from the last couple of quarters, all the way into Q1 2020 from Crunchbase. You can see where the money is going, a lot of late stage, but a lot of early stage, a little bit even into angel and seed stage. We talked last week why that is, why you would expect a $1 billion fund to maybe make an angel investment. Not very often, but it does happen. Mostly I do what's up there at the top in the red is technology, but actually most of what I do is early stage in the green, I think about it. But you'll see that there's still quite a bit of money available and a lot being invested, even though there's been a little bit of a downturn. And I think we're probably going to expect a bigger downturn for Q2 2020. Certainly there is. Anecdotally, I will tell you that I've seen less money being invested, but that doesn't mean there's no money to be invested. In fact, for some companies, downturn is not a bad time to start a business. In fact, General Electric, General Motors, Microsoft, those companies were all started in downturns. Venture-backed companies, Uber was started in a downturn, in a recession. Airbnb was started in a recession. So just because we're in bad times doesn't mean that the venture capitalists are going to give the money back and go away. They're not doing that. They're out there. They're pausing. I heard somebody today say they're going to pause for 3 to 6 months to maybe a year and wait for valuations to come down. But I don't think they're going to sit on their dry powder for that long. I think it's still a good market. Here's again some statistics for you. You'll see again, a little bit down, but still strong in terms of growth investment. Okay, let's get into the nuts and bolts and the meat of this. The first thing that you should have, this is even more important than a pitch deck. It's an executive summary. All the VCs that I know, they just love seeing this because they see tons and tons of deals. And before you do anything, they're going to want to know whether you're in their sweet spot or not. And the quickest, easiest way to do that is not after 90 minutes of your grand vision of how you're going to change the world, but just a one-page summary. This is the team. We talked last week about how important the team is, right? Maybe the most important thing. This is our technology. This is our market. This is our industry. This is how big it is. This is why we're a good candidate for you, venture capital, in a snapshot. If you can get past and don't put, for God's sakes, don't put valuation in your executive summary, right? You wait a long time. Hopefully you'll never raise it. The VC will tell you what you're worth. This is just to get them excited about you and your company and your vision. If you get past executive summary, we'll get to the pitch deck. We talked about this again in session 1, but I want to remind people, your pitch deck, I'd like to see it be 10 slides. I know hardly anyone can stay to that, but basically you're just going in more depth on really important things. And what's important to a VC, keep in mind, we talked about venture capital economics in our last session. They need to hit home runs. They need to hit it out of the park. They'll take big risk for big returns. That means that you got to be the very best possible team that they can bet on for this company. And you got to be in a market that's big enough for them to get a very, very big exit. And we'll show you some of the economic terms that they're going to be looking for when that big exit comes. And of course, there are all the other metrics. They want to see your go-to-market strategy. They're going to want to see your financials. They're going to see your technology. Okay, so let's talk a little bit about what you can expect before you get there. So I like to tell people that before you get a term sheet, mistakes are free, right? Most of them are. We can fix it. In fact, I wrote a whole book about the mistakes you can't fix. It's called Dead on Arrival, How to Avoid the Legal Mistakes That Could Kill Your Startup. Shoot me an email if you'd like a digital copy of that book. But most mistakes and most problems and most places where you did it yourself or went online or downloaded forms, most of that I can correct before you get to the term sheet stage. Once you sign a term sheet, those mistakes are not free anymore. If your investor tells you that you did something wrong in setting up your company, it's going to cost you valuation points, right? Or it's going to cost you the deal or something like that. So what are the important diligence points? I just want to go over a couple of them because these are probably the most important. Cap table, IP, and then some of the other legal stuff. Okay, hold on. Another chat message. All right, next question, cap table. So we're going to get into this, but your cap table, you needed that to be in shape before you even get to the venture capitalist table. You want to make sure that the cap table is not in a position that it can't be fixed or can't be adjusted, and you can't give the VC what they're looking for. What is your venture capitalist looking for in a cap table? Well, let me give you a few things. Number one, they want to know there's enough common stock available to incentivize management and future management. Okay, so that means, as we discussed last time, we don't want to have a lot of vested common stock in departed founders. I mean, sometimes it's unavoidable, but we try to avoid that result. We don't want to, for God's sakes, you don't want to be selling common stock to investors, right? You're taking up all of your dry powder. They should be getting preferred because they're paying more for the preferred and less for the common, so they'll have a smaller percentage of the company if they buy preferred. Or more often, you're going to sell them convertibles, notes, or safes. I'll talk about those in a minute. There may be warrants you gave to your landlord or your possibly some of your service providers, your investors, your debt holders, in some cases your babysitters. It happens in Silicon Valley. There'll be people hanging out there with warrants. We live with that. And that's what's going to be on your cap table when you get to the VC, because they're going to buy preferred stock. Let me, for the uninitiated, let me kind of go through some of the cap table. This is what I mean by cap table. It's just a table of how many shares everybody has. Here's the sample cap table, and this is one I like to back in to my cap table. I like to project out where we want to end up after. First of all, what do we need before we can exit? How many rounds are we going to take before we exit? And as we discussed last time, we want to stage those financings so we only take enough money to get to the next valuation metric, which will be between 1 and 2 years. And hopefully we double our money in that time, but usually not, but that's what we try for. And I back into those numbers and just say, these are our targets. This is what we would like to have happen. And it's a good exercise to get into so that we can start getting used to running what ifs, because we should be spending quite a bit of time doing what ifs with our cap table. And when we figure out what it's going to look like when we start bringing in investors and giving stock to other parties, and when you're going to lose control. Now, in this particular cap table, I'm saying the founders started with 5 million. We figure we're going to have a stock pool of 2 million by the time we're done. The Series A will take 3, the Series B will take 3. That's both about 23%. Just rough numbers. Notice the two differences between fully diluted and issued. Issued is your actual voting rights. That's stock that's issued and outstanding. People hold and can vote and receive dividends on. Although nobody pays dividends, they can vote it. Fully diluted is what would happen if all of the convertibles converted to stock and if all of the options that have been issued and are outstanding were exercised for stock. And that's a much different number. We want to be very focused on the issued number when it comes to voting control. And with this cap table, I can tell you by looking at it that the founders maintained control of this company after Series A and then lost it after Series B. That's a pretty common fact pattern. Now, I've told most of you a lot of things that you already know. So now let's start to drill down a little bit. I'm going to come back to this slide on valuation caps in a minute, because I want to talk, before we get to that, I need to explain what a SAFE is and what a convertible note is. And if you already know, because you've already done this, you can take a nap and you can come back in about 2 or 3 slides. So the way that you're going to take early pre-venture cap, and this is important, this may not solely to the VCs, but it's going to be very important to the VC. And I'm going to tell you why in a minute. The way that you probably have raised money before you got to the VCs is you put some of your own money in. You mortgaged your house or cashed out your Roth IRA or whatever. Or you took friends and family money, in which case you had to give them a security, or you did an angel round, in which case you gave them a security. The security that you probably sold to them was probably a convertible note. That's just debt that converts into stock whenever you sell stock, right? It's a promissory note that turns into a share of preferred stock when you sell stock to the first equity investor who is likely to be a VC. That's a convertible note. For years and years, that's the only way we did these deals. And then along came this instrument called a SAFE. There was also a KISS, and there were also some warrants that I've been using for 20 years that nobody liked that did the same thing. But the concept was that, look, these convertible notes, they never get repaid, right? Startups, and nobody wants a debt return. They don't want interest. That's not why they're taking equity risk. They don't want a debt return. The whole idea is just to defer the valuation decision. So I'm going to loan you money today in exchange for stock tomorrow when a professional investor comes in and values your company, and then I'm going to take stock at a discount to that price. So for every $1 I loan to you today, every 80 cents I loan to you today, you'll give me $1 worth of stock back when you do your equity financing. That was a convertible note. Well, trouble with notes is they had to bear interest, otherwise they weren't promissory notes, they weren't debt. And number two, because of the way the banking rules, the lender laws work, they tended to be short term, usually 1 year, sometimes 2. And that just wasn't enough time for most startups. So you found a lot of startups being forced into a default because the note would come due, they wouldn't have the money to pay it. the note holder wasn't going to foreclose. Sometimes they didn't. They took the company. Usually they just sat there and waited until the company actually found the VC and did their investment, and then the note converted. Rarely did a note ever get repaid. Not never, but rarely. Usually that happened only when the company found a later investor that was willing to take out the notes. So we decided, well, why even go through this fiction of pretending we have debt here? Instead, why don't we call this what it is, which is convertible equity, and that's where the SAFE came along. So the concept behind the SAFE, simple agreement for future equity, again, it's like I said last week, it's kind of the way that Wimpy would borrow money from Popeye to buy hamburgers. He said, if you give me $1 today for a hamburger, I will gladly repay you on Tuesday. Same with the SAFE, right? You give me $1 today and I will gladly give you equity on Tuesday when I do a financing. If the company never does a financing, you don't get your dollar back. You don't get anything back. You're taking equity risk. No interest, no term. It just converts, you know, when the company finances. That's how we always do these deals, almost always do these deals now. Okay, everybody understand that. Now, two things. One, because you got in early and you saw the future and you were the visionary and you bet on the founder and you believed in me when nobody else did. I've heard that before many times. We're going to give you a discount. In other words, you're only going to pay 80 cents for every $1 of stock that you get. That's a 20% discount. Okay, we get that. Secondly, we're going to put a cap on valuation. We'll explain what that means in a minute, but basically it means that my money is going to get at least some minimum percentage of this company, because if I bought stock in your company today instead of one of these safes, it'd be at a very low valuation. I'd have a very high percentage. So just because you're worth 50 million when I finally do convert doesn't mean I should have a teeny percentage. So we have a valuation cap. I get some minimum percentage. Alternatively, you would see these with a most favored nation clause, which basically says, look, just give me whatever rights you give the next investor. Make sure that whatever I get is as favorable as the next guy. Now, I want to focus on these two things. The discount, you know, 20% is pretty common, a 20% discount. Sometimes you see 15, sometimes you see 25, but I wouldn't get bent out of shape over the discount rate. You know, if you do the math, it's going to mean a few shares one way or the other, not a big deal. Okay, so there's not a, you know, it's not a huge amount of value in being just exactly precise on market, on discount. It's usually around, in my neighborhood in Silicon Valley, that's what a discount typically is. So again, as I said, you know, for every $1, for every 80 cents that of SAFE that I bought, I get $1 of preferred stock. So the VC is paying $1 for it, I'm paying 80 cents. And actually, I'm not getting the exact stock they're getting. I'm getting a shadow preferred, but you get the idea. I want to talk about this other thing, the valuation cap. So the SAFE price is going to be your valuation cap divided by your number of shares. So there's two kinds of valuation caps. One is called pre-money, the other is called post-money. So a pre-money valuation cap, I just go ahead here, is simpler. I like it personally, some lawyers don't. And it basically says, we're going to invest at a valuation in my cap, the minimum amount of stock I'm going to get when I convert my SAFE is going to be based on the value of your company today, before options, before other equity, other safes, before other investments. It's today, right? So if I invest $1 million at a $4 million pre-money valuation, and you don't take any other money, well, my million's going to be worth 20%, 1 million over 5 million. That's a $4 million pre-money. If I invested a $4 million post-money, my million's worth 25%, 1 million over 4 million. Well, kind of the tricky part about this is that whatever happens after the date I invest is going to dilute me, the investor, and not you, the founder. Well, it'll dilute both of us, really. But I'm the investor when I take that, because I invested on a pre-money basis as of the date that I invested. So the option plan could go up. That's going to dilute me. All sorts of things could happen. And because of that, I don't really know what percentage of this company I'm going to get if we trigger that valuation cap. You just don't know. You can't tell. You can't predict. You can't figure it out until you actually get there, because you don't know what the cap table is going to look like. All you know is what it looks like today. So along comes the post money. So investors could get some certainty and say, look, I don't care what you do between now and the time I invest, but as of immediately before you do your institutional financing with a VC, I want to know that I have X% of the equity for my money. That's the least amount of equity I'm going to get for my money. That's a post money cap. Investors prefer those. They're more complicated. I don't like it because it shifts some of that dilution back to the founders. And I typically represent companies, sometimes VCs. But that is starting to become the standard. I'm seeing more and more of those just because it's so nice to be able to, model your cap table and kind of know where people are. So that's the difference between pre-money and post-money. Now, I told you that so I could tell you this. Let's use an example. So here's my cap table. Here's my, okay, yeah, these are the numbers that I just told you, right? This is the company sells a 1 million safe with a 4 million pre-money. If nothing else happens, but other stuff is going to happen. So these numbers aren't going to hold. And this is the other stuff that's going to happen. You're going to see other safes. You're going to see a stock pool, etc. All righty. How are we doing on time? One other thing about the safe I'll mention, by the way, what happens if you never do financing? I said the safe doesn't get, doesn't get anything. Not entirely. If the company gets sold, if you have a change of ownership before you do a financing, the safe is going to usually have the option to convert to common stock or get a multiple of their, of what they invested on a sale. So they're not completely out of luck. Okay, let's move on. Enough said about safes. We could talk all day about safes. And finally, and again, this is all cap table. By the way, not enough said about safes. I want to say one more thing about safes. You have to be careful about this. One of the advantages of the post money and knowing kind of how much dilution you have out there is that you know how much is going to be left over for the founders when you do your institutional round. And one of the things you need to be, let me use another cap table. One of the things you need to be super careful about with safes and convertible notes for that matter is that it's really easy. You don't have to do it all at a closing. You can do rolling closes subject to securities laws, etc. You can sell safes as you need money. You take money in, you sell a safe. I see safes go out for ridiculously small amounts of money, $5,000 at a shot. You should only let me invest that amount because it's not worth the hassle for that amount. But I know companies will do it because it's just so easy, right? You don't have to have a big fancy close. You don't have to have an escrow or trust fund. They give you the money, you give them the safe, it turns into stock if ever down the road sometime. Well, that sneaks up on you because you'll do a bunch of safes at low valuation caps, right? And before you know it, you've given away 13% of your company in safes. And you don't know it if it's a pre-money safe until you do the financing because you don't know what percent it is. Now, I'm pausing on this for a long time because I have seen over and over again and again, companies not being able to do their venture round because they've just given away too much of the company at too low a valuation cap in the form of convertibles and safes and sometimes Series Seed. So you have to be super careful about that. And one way to protect yourself is to have high valuation caps. These days, 10 to 12 million, that's probably going to go for an early stage company. It's probably going to go down. I know I say that, and the angels and the VCs in the crowd all freak out and they yell at me and send me hate mail. They don't like that number. That's what I see. I think that number is going to go down this summer. But you want high valuation caps if you have them at all. And you want to model. You want to continue to do these sorts of what ifs so you know how much your company giving away. 13% in safes is not that bad. I see companies that have done way worse than that. And institutions come along and say, just forget it. You don't have enough stock left over for the founders. We're going to have to do carve-outs down the road to keep the founders around and do reverse splits and all that stuff. And we don't want to do that. So be super careful about safes and convertibles. The fact that they're easy is the thing that makes them very dangerous. Series Seed preferred. Suppose you have an investor that absolutely positively wants a priced round. What a priced round is, they want to know exactly how much stock they're getting in your company. They don't want a cap. They don't want to know, maybe I'm getting this, maybe I'm getting that. They don't want the uncertainty. It's just, we're going to value this company today, and I want X%. Well, there was a time when that was just totally it was just almost undoable for less than $1 million investment, because a preferred stock round was so expensive to negotiate. And who knows what the valuation is of an early stage company anyway. Well, along comes Series C preferred. It's watered down, stripped down. It's like preferred stock, but very simplified. So we can do these things for a small amount of money, $5,000 to $10,000, usually with no due diligence. And by the way, there is no due diligence because your company doesn't have anything. It just started. But it's a simple, I'm going to tell you what all these terms mean tonight. But trust me, it's just very super simple terms, but it's not common stock. It's preferred stock. The difference is that it has a preference. Preferred stock gets paid first before the common unless it converts to common. Okay, that's important. That's the technical difference. The real difference is that you can sell it for a higher price than the common. And if you don't remember anything I said tonight, remember this, right? You want your common stock to be cheap so you can sell it at a low price to your service providers. So you're trying to incentivize, you're not trying to raise money from them. You want your preferred stock to be high so you can sell it for a lot of money to your preferred investors because you need their money and you want to give away as little of the company as possible for their money. You do that with preferred. And if you absolutely have to do a priced round, do not sell common to raise money, sell Series C preferred. Now, having said that, I see companies sell common all the time. So those are the exceptions that prove the rule. These are rules of thumb. All right, I'm going to get into what all this stuff means in a minute. But for now, this is all the stuff you don't get with Series C. That's what makes it cheap. That's what makes it easy to do. No preference, who cares about dividend preferences anyway? No registration rights, no anti-dilution, no co-sell rights, limited reps and warranties, and yay, no legal opinion. You don't have to pay me to do that. Okay, a couple other diligence issues, and then we're halfway through. I want to get into the term sheet. So IP rights. I'm a big believer in patents. We talked about this last time. Most companies, they don't go out early enough to get their patents. We're on a first to file system here. In other words, so it's really important in the United States, first to file, that's who gets rights and patents. It's important to get your patent filed. We talked about provisionals and ways that we can do that before. Invention assignments, get those lined up. Make sure that everybody who has touched your IP has assigned that to the company. We do a whole program on this. We'll probably reprise it in July on startup basics on how important IP ownership is. Licenses and ownership, I like to tell people I spend half my time protecting my clients from other parties and the other half protecting them from themselves. This is one where you have to be careful about what you agree to and careful what you ask for and careful about getting what you ask for. A lot of contracts that you ask people to sign might give away a little bit too much of your IP. And the hot new thing, of course, is data security. The bad guys are out there. We need to make sure that they're not compromising your company. Again, startup basics. We do an entire hour on this. We'll probably reprise it in the middle of July if you want to do a deep dive into all these startup issues, including these other diligence issues that pop up. Employment claims we have to watch out for, especially if you're unlucky enough to be in California. An employment claim can wipe out a company and you can have personal liability for that. Tune in June 9, you want to hear more about that. Tax claims, regulatory, litigation, your prior employers. Google the, what's the case? The Uber, Google, Waymo case and find out something about claims by prior employers and how that can be a major headache for a company. Entrenched management, make sure you have your vesting in place, material agreements. Same thing, review those carefully. If there's something wrong with it, you want to fix it. You want to get it taken care of before somebody else tells you to. Okay, how much money should we raise? We talked about this last month, enough to get to the next valuation event. We're shooting to double your value within the next 1 or 2 years. If you don't do it, don't freak out. Don't set an artificially high value that's going to set you up for a down round later. We're talking on June 9th about down rounds. You don't want to be there if you don't have to. It's not fun. It's not pleasant. And it's going to hurt you because of the way the anti-dilution adjustments work. It's going to hurt you, the founder, more to do an up round than a down round to just do flat rounds. I'm going to show you the math later. Yay, term sheets. Okay, lucky you. you've had your 3 meetings with the VCs, you've had your Zoom calls, you've given them your executive summary, they liked it, they saw your pitch deck, you had this little dance, they might have even floated a valuation number. By the way, if they didn't, and if they ask you to tell them, that happens sometimes, be prepared. Again, we have a whole program on that we'll probably do in July on how to value your company. But usually they're going to tell you, number one, what your valuation is. In fact, most founders, that's the first thing you're looking for because you think it's the most important. It's maybe not, but I know it's the first thing you're looking for. So how does the VC come up with that valuation? I've identified 30 different ways that I know of that VCs, some are more scientific than others, have used to come up with that number. In fact, if anybody would like a deeper dive on that, I have a memo on all of those ways. Email me, I'm happy to share that memo with you. But let me give you a really, here's a handful of them. These are different methods. And I'm not going to go into these because as a practical matter, if somebody asks, you go into them if the VC asks you to value your company. And what you'll do, you'll find 3 of them that converge. You put it in a spreadsheet and you'll say, I found 3 methods that give me this value. This is my number. Otherwise, they're going to tell you what the number is. And hopefully you're shopping and you've got more than one term sheet so you can get a good idea. I'm going to tell you how to compare term sheets in a little bit. But here's the best way I've ever heard to value a company. One of the, I won't say who, but one of the partners at one of the top tier white shoe Sand Hill Road venture capitalists over a lunch of sushi one day told me, here's how I value companies. He said, I figure out how much of the company I need. I figure out how much, they tell me how much money they need, and poof, there's my valuation. It's about that scientific. But it is surprisingly efficient. You're going to find surprisingly that different funds are going to come across the same numbers. So they're all, using the same gut instincts. Here's a couple more: patents plus people times 1 million. I like that. Comparables. Here's what they'll tell you they're doing: discounted cash flow. We're discounting you by 40% to market publicly traded companies in your space, etc. The VC method that you might have heard of, that's what they call the harvest value. Let me back up a little. Let's talk a little bit about it. So the VC method, venture capital method, that's technically it's what they call harvest value. That's where they're going to exit at, divided by their anticipated rate of return, which has got to get them about 10x to 30x. Because remember what I said, they're looking for home runs. All right, so they're projecting out. That's why the market size is so important. What are you going to be worth? What am I going to get on my investment? What kind of ROI is that? I can tell my investors. The Cayenne calculator, it's 25 questions you go through, and it just weights them all. What else do we have here? Burkus method, that's 5 characteristics that you value. You give $500,000 to each, that adds up to your valuation. Discounted cash flow is what most people will tell you, that they're going to, again, back into, that's what I hear people say. They're going to back into your exit value and can come up with a rate of return, etc. All right, let's move along, because like I said, valuation is not going to be your most important issue, but that'll be the first thing that hits you, in the face when you look at that term sheet. The next thing you should be looking for is the idea of participation. So what is participation? So there's 2 kinds of stock: participating and non-participating. Participating preferred means that the stock is double dipping. It returns its investment and then shares pro rata. So if I have 1x, and 1x means I get it one time, participating preferred, it means if I put in $1 million and I've got 10% of the company, that means when you sell the company, I get $1 million plus I get 10% of the company. That's participating preferred. Non-participating convertible preferred, which is that's almost all I've done for the last several years because the market's been sort of favorable. Read frothy. Non-participating preferred, they have to choose. So you sell the company and the investor can take their preference, the amount they put in, they get that back, or they can take their 10%. So if I got 10% for $1 million, if you sell the company for 20 million, I'm going to convert to common, take my 10%, that's 2 million. If you sell the company for 5 million, I'm going to take my preference and not convert, that's 1 million, that's twice the 500,000 I would have gotten if I'd taken the 10%. Now, we're going to see participating preferred make a big comeback this summer. Just promise me. I was around in 2008 when we went through this before. I was around during 9/11 when we went through this before then. I was around in 2003 to 2006, and we had another, 2006 was another downturn. In the 90s, we had a lot of participating preferred. I believe it's going to come back. So how do you protect yourself against that? We usually cap it and say, look, okay, we'll let you participate, but you got to stop someplace, right? We'll talk about conversion in a minute. That's in the wrong place. Okay, so that's participation. You get your money back and you take a share, or you non-participating, you only get your money back or your share. Dividends. Preferred stock is going to have a dividend preference. Now, for those of you that have experience in the private equity world, you're probably familiar with a cumulative dividend. In other words, and it depends on what else you're giving up in the deal, but most private equity deals are going to have a cumulative dividend. It's a lot like debt. It just accrues, and if you can't pay it this year, it just gets added to the ledger and you pay it next year or the year after, or whenever you exit. You don't see that in venture capital. You just don't. Instead, what you see is a non-cumulative dividend. That means if the corporation doesn't pay it, it goes away. It doesn't accumulate. You don't get it next year or some later year. And what you always see in venture deals is a thing called when, as, and if declared. So if the board does declare a dividend, the preferred have to get their dividend before you, the common, do. But if they never declare a dividend, then there's no dividend. There's no dividend to prefer. I put it that way. And I don't remember the last time I saw a startup company declare a dividend. There's so many reasons why they don't. But the biggest one is very few of them are profitable. And if they are profitable, that want to actually distribute that money. By the way, let me pause on that for a minute. Why is that, do you suppose? We talked a little bit about this last time. Why is it that so few startups are profitable? Are you just all bad businessmen out there? Do you guys not know how to make money? Is that it? No, that's not it. It's because if you're profitable, you're looking at short-term gains instead of the long-term humongous gain. If you're profitable, you're paying tax on that profit, first of all, and there's nothing a VC hates more than paying tax, right? Just look at the capital gains rates and the qualified small business stock exemption, right? And that's going to be a drag on the company. And secondly, that means you're probably limiting your growth, right? The freemium model is better because you're going to grow. The less profitable you are, you want more eyeballs, not more dollars in the bank, because that's going to increase the value of the investment. And most venture deals, you need explosive growth. You need to get into the market and take your market before somebody else does. You can't be screwing around trying to nickel and dime a few short-term profits. You really want the market. And some of these companies, as you know, no names mentioned, they get all the way to going public and being public and still not turning a profit. They want the market. So if you're not profitable, you can't legally pay dividends. And very few companies that I work with pay dividends. Okay, let's talk about the preference, liquidation preference. That is who gets paid first and how much. Okay, the liquidation preference. So usually it's 1x, okay? So a 1x preference means that the preferred stockholder is going to get all their money back before you, the common stock, the residuary, get anything, all right? If it's a multiple preference, 2x, it means the investor gets 2 times their money back before you get anything. Okay, that's the liquidation preference. That's the third thing you're going to look at. And then you'll do some what ifs. You'll run some numbers. You have to model this and say, what happens if we sell this company for X, Y, or Z? How much am I going to get? And these days, I'm looking at a lot of companies where you're scratching their head thinking, why are the founders even still here? Why are they working? They're never going to clear the preferences. They're never going to pay the preferred. The company is never going to be worth enough to pay the preferred, given what's going on in valuations. Not there yet. I will be in another month, I think. Actually, I'm there with a couple of companies. So I'm going to tell you what we do about that on June 9, by the way. But that's why you need the model at the front end, because it's a lot easier to address these issues up front than have to go back and recap the company later. And we talked about multiple preferences. We talked on caps. Okay, you get a preference, you get your money back first, and you get 2 times, and you're capped at 2 times, that kind of thing. And I have a handy example for those of you who like math. This is the one I think that I just gave you. Suppose we have 1x. Okay, what does 1x mean? It means I get, on the VC, I get 1 times my money back. Non-participating convertible, what does that mean? It means I either get my money back or I participate, right? I convert to common stock and get my percentage. And we just do the math. I put in $1 million for 10%. We sell the company for $5 million. 1x is $1 million. 10% is 500,000. I think I'll just take my preference. Thank you very much. Opposite result, we sell it for 20 million. You get it. Board representation. We could talk a lot about this. In fact, the VCs do. They talk a lot about this, and but I'm not going to. I just want to hit on a few things. I only have a few slides on this, things that you need to be aware of. So I want to give you some metrics. Size of the board. I'm a big believer that less is more. I like to see a 3-person board, always an odd number, by the way. You don't want deadlock. That's good work for my litigation partners. Not great, not a great result for me. You want an odd number board so they can make decisions. And I like smaller boards, so it's not so hard to get everybody together on a Zoom call or in a room. And back in the good old days, meaning 2 months ago, we used to all sit in a room and do this. So 3 is where I like to be at the end of Series A. 3 is also where I like to be when we form the company. So if you do the math, you'll realize that somebody is going to have to come off the board for the venture capitalist to put somebody on. Now, who's going to be on that board of 3? The CEO or somebody selected by the common, for sure. The VC or somebody selected by, the VCs as a group, but there's more than one, for sure. Who's going to get that 3rd seat? So you hear about founder-friendly boards. And a founder-friendly board would be a board where it'd be somebody else selected by the common, right? Or somebody friendly to the common, to the founders own common stock. Usually it's an independent, industry luminary, independent. Independent directors are not always very independent. They just look independent. We'll talk about that before we're done here, how important that is. But that's usually what you're going to end up with. Now, it's really interesting. Here's a founder-friendly board, and this is all public, so I'm not speaking out of school. Uber has an 11-seat, or they had an 11-seat, not anymore. They had, they had an 11-seat board. 7 of them were filled. 4 could be selected by the CEO. Do the math. What did that mean? That meant that if that board ever turned on the CEO and wanted to kick him out, he would fill the other 4 seats and secure his seat. So that's the kind of strategizing that gets done in these sorts of deals. Unless you're Uber, you're not going to have an 11-member board. You're probably going to have a 3-member board, but just be sensitive to that, how powerful the board is. So let's talk about that. What is the roles of the board? The board of directors manages the company. They're responsible for the day-to-day management of the company in the day-to-day affairs. They select the officers will sign the documents, but the board is going to make those decisions. I'm going to move pretty quickly because we're running out of time. I just want to say 2 things. Every board member needs indemnification. They won't do it. And board members should have insurance, D&O insurance. They're going to want that. The VCs, they've finally all figured out, because VCs have their own D&O for their funds, that they want your insurance to pay claims before their insurance has to pay claims. So you'll negotiate those provisions, but they're all going to want to be insured. And if you're on a board, you want to be insured. It's a risky thing to do. If something goes wrong, you're going to hear all about it on June 9, by the way. By the time we're done June 9, you're going to wish the sheltering was in effect for another 2 months. Okay, protective provisions. That's another part of the term sheet that we're going to see. And it's either going to be a class vote or a majority vote of the preferred. What I mean by that, you'll have a Series Seed 1, Preferred A, Preferred B, etc. Class vote means every one of those letters of the alphabet, they get their own majority vote to approve something. Majority vote means they all vote together. Protective provisions mean that the preferred, they get to vote on certain major actions by the company that would affect their rights. Here are some standard provisions. Here are some additional provisions. Again, this is something that people ought to think a little bit more about, because the later investors, they oftentimes will demand a separate vote. But you think about it, suppose all the preferred in the first 3 rounds are voting together, and then a later investor comes along and says, well, I want a class vote. Well, they have disproportionate, through a protective provision, they have a disproportionate right um, given the amount of their investment. So those things tend to get negotiated and modeled, right? And modeled. Use the software. I was just on it today before I signed up. It's brilliant. The software programs, you can do what ifs. You can say, put a yes in these boxes and see what kind of percentage we'd end up with. So it's super easy now to model this out, and we have to do it because who do you want deciding? It used to be you only had these standard provisions. Now you're seeing all these other ones, right? The preferred, and the argument is, look, preferred stock, you got a director, that ought to be enough. The preferred says, well, that's not enough because I only have one, and I need to make sure you don't incur debt, or hire your brother-in-law or stuff like that. So tends to be negotiated. Information rights. Anybody who owns a certain amount of stock is going to get financial statements and other information. It's not everybody. Don't give information rights to everybody. It'll drive you nuts having to send those statements out to every $5,000 dog and cat investor. Registration rights. This is about all I'm going to say about it. In the, 100 years or so that I've been practicing, I don't think I have ever once seen anybody exercise their registration rights. What it is basically is a right to force the company to either go public or to include their stock in a registration, because in the United States you register stock, not companies, in a registration that's piggybacked, or to demand that the company register your shares on an S3, which is a short form registration for already public companies. Way more than you need to know. Don't negotiate those. In fact, I don't even like to put them in the documents. I just say, look, we'll give you whatever reg rights the next investor gets. Sometimes I get away with it. Pro rata rights. Again, major investors, you don't want to go to the trouble of figuring out pro rata rights for every dog and cat investor, but major investors are going to keep a right to maintain their percentage investment. If you got a hot company and your valuation's going up and everybody in the world wants to get in on it, this gives the early investors the right to keep their 10% or whatever it is in the next round. It becomes a real issue when the round's oversubscribed. And what oftentimes will happen is they'll just keep increasing the amount that you take in until you've got more money than you want. You gave away more of the company than you want it to. Co-sale, drag along, tag along, right of first refusal, just what they say. The co-sale means that if I, the founder, want to sell the co-sale, if I want to sell some of my shares, I have to give the investor the right to sell some of their shares to the same buyer. It's a right to participate. Drag along is just the opposite. If I, the investor, if I find someone who wants to buy my shares, I can force you to sell your shares in that deal, and you're not going to dissent. You're going to go along with the deal. Those tend to be litigated when they're exercised sometimes. And right of first refusal, that means the company has the right first to buy shares back before they can be sold to any third-party buyer. You'll see those in every deal. We covered this last time, so I'm not going to go over founder vesting. Just remember you're going to revest. Just plan on that. I want to give you a couple of things. Option plan is part of the term sheet. It always gets increased pre-money. What does that mean? It means that, gee, that's a cute little 10% option plan you got there. We, the VCs, want it to be 20% if we're putting our money into this, and that extra 10% comes out of your hide, Mr. Founder, not out of ours. That's what I mean by increased pre-money. Here's something we're seeing a lot of these days. The exercise periods for options. Everyone knows how options work. An option is a right to buy stock in a company. It's a great deal for the employee because they're granted an option. They have no tax consequence. They don't have to give you any cash for the option. They just sit there and wait. And if the company goes broke, like some of them do, I'm told, they're not out anything. If the company increases in value, they get the spread. That's an option. They exercise the option or cash it out. Well, most options will have a provision that says that after the employee leaves employment, they've got 30 days or sometimes 90 days. If it's an ISO, usually 90 days, that's statutory, to exercise the option. Well, that's not enough time, right? I want my exercise period to go on for years. And companies are granting that more and more and more. They're saying, all right, now if it's an ISO has to be exercised within 90 days. I'll tell you all about it in July, what that means. So this only applies to non-statutory options. they can be extended. But I push back on that. I'd suggest you do too, because it really messes up your cap table. It's just kind of hard to know what your fully diluted shares are when you've got options that are not going to expire. You suffer a lot of dilution, and it kind of defeats the purpose of an option plan. The whole point, right, is to attract and retain good people. And if you're giving them an incentive to leave and sit back for the next year or so waiting to see if the company does well, you're not incentivizing retention. So I don't like it, but as usual, people don't listen to me, they do it anyway. Redemption rights, yeah, not so much. I think we all had, I can't remember when, but there were a few years and I saw these in every deal. It sounded good at the time. I think we all came to realize that it's really hard to exercise a redemption right. First of all, company, if you want to redeem, company probably can't redeem you because they're legally prohibited by rules that govern the amount of capital and retained earnings they must keep. And as a practical matter, it's really just a right to force a sale of the company. That's how I look at it. I think they may come back just because people are going to start asking for everything if they can, but don't see it very often these days. At least I don't. Anti-dilution, I'm going to talk a lot about this on June 9. You'll find anti-dilution protection. This is the idea that your investor gets in at a certain valuation and the company goes down in value. They want to be protected against that. Now, that doesn't mean that their stock just automatically adjusts to the price of the down round. That's called full ratchet anti-dilution. Hardly ever see that. We're going to see it more now because you see it in troubled companies, right, that have no other options. They have to take whatever's shoved down their throats. So we're going to see more of that, but hardly ever do you see that in a company that's on the way up. Instead, we get what we call broad-based weighted average. I won't go into the details, but there is a standard formula. Everybody uses it. It is mind-bogglingly complex, but basically it averages the effect of the dilution over all of the stakeholders, including your option holders. That's why it's broad-based. That's what you're looking for, not the full ratchet. Exclusivity, expect 30 days. Sometimes someone will try to sneak a 90-day exclusivity clause in. That means once you sign that term sheet, you can't go talk to anybody, right? You can't talk to anybody about taking in financing. And if somebody contacts you, you got to go tell your existing investor while you're negotiating the documents. The investor wants that because they don't want to be putting in a bunch of effort in the company only to have the deal taken away. So that's standard, but limit it to 30 days if you can. Same with confidentiality. Here's a good one for you. The term sheet's going to have non-binding stamped all over it. Is it really non-binding? Be careful about that because this is California, and our California courts, they impose an obligation to good faith on almost every duty. And if you sign a term sheet, I think you're binding yourself not only to the 30-day and the confidentiality clause and the stuff that says it's binding. I think you're binding yourself to negotiate in good faith for a deal. The investor is too. And they know who they are. There are investment funds that will sign a lot of term sheets with no intention of closing. Just a matter of time before one of them gets tagged for that. Wow, it dropped in a tax slide. All right, it's too late at night to bore you with this. I do want to tell you one thing. Talk to your accountant before you do a deal because you may be giving up the right to claim net operating losses against your income as you go forward. We see these inadvertent ownership changes all the time. It's on my checklist. I don't know if it's on anybody else's. Be careful about this. You might have to give it. And what this is the right of the company post-financing to use their pre-financing losses against post-financing income. Eventually, you are going to have income, even if it's going to be a while. After an ownership change, you can't do that. So be careful. That's all I want to say about that. And just know that you're giving that up, which you probably will. Planning for later rounds. And now I'm getting out of term sheet stuff. I know I went through that fast, but we'll do it again sometime. So I want to go into the softer topics. Be careful about a couple things. Number one, overly favorable terms. And this is a fallback position. At some point, when you're just getting the crap beat out of you in a negotiation by the investor on terms, at some point you have to remind them, look, the next investor who comes along, they're going to look at this cap structure. They're going to look at the certificate of incorporation. They're going to say, wow, look at all this stuff this company's willing to give me for free. I don't even have to give them anything for it because they've already given that up. Keep that in mind. You know, everybody keep that in mind, that you're setting precedent when you give terms that are too favorable, like full ratchet anti-dilution, for example. Secondly, I hit on this, valuation planning. You would be wise not to go for a valuation that you know in your heart is too high if the next valuation is going to have to adjust back to market, because it is really not a happy thing. It's not a good thing to do a down round. It's complicated, right? It puts you in a whole different category. It sends a message out to the investment community, and it hurts your position because you get diluted in the down round. And unlike those VCs who negotiate, remember I told you I was going to come back to this, those VCs who negotiated for anti-dilution protection, you didn't. So you get hurt more than they do. So be careful about this, model this out, and don't take more money at higher valuation than you think you'll need. The other thing, reverse splits. Every once in a while I get companies that come in and they want to have more shares authorized and more shares issued than they should, right? Because it just sounds cooler to have 100 million shares than it does 10 million shares. Well, yes, until the VC comes in and they take a look at it and they say, well, this just looks silly to have this many shares for this low value company. We're going to make you a reverse split. You don't want to do a reverse split. And sometimes it happens because your valuation goes down. And that's what the market is going to think. If you do a reverse split, they're not going to think, oh, you just screwed up on your numbers. So avoid that. Manage the cap table. We talked about. Fire the CEO. I want to remind you folks that very few CEOs go from start to finish. So few that you probably can name all the ones that have done so. Just be prepared. Be prepared that you're going to be eased out of this company at some point. It's a rare person that has the skill set to be entrepreneurial and, you know, a Carl Jungian magician that can envision the future and create something magically that didn't exist before, that same person is a Carl Jungian God who can now, father figure, who can manage something and protect it as it goes into its growth stage. So pardon the metaphor there, but just be prepared to exit, and you'll want to have your separate counsel. Say that again, you should have your separate counsel help you negotiate your own agreement with the company so that when that exit comes, you're well protected. That's it for VC. I want to mention corporate venture capital. We didn't talk about that. We could do a whole hour on this. My friend Andrew Romans from Rubicon, the VC, wrote a whole book on corporate venture capital. I will tell you that, and Andrew's going to disagree with me probably, that in some ways it's easier, in some ways it's more difficult. It's an easier negotiation, I find, because their objectives are strategic and have less operational involvement. That should be right of first refusal, not tight of first refusal. They're going to want rights to buy your company on the back end. That's bad. Don't give them that. You can give them a right of first look. The real challenge I hear from people who take corporate venture is that corporations move their people around so much that you might have trouble getting their attention and getting them to show up at board meetings and getting them to sign stuff. As weird as that sounds, I hear that objection vociferously. All right, next, June 9, we're going to talk about troubled company terms. All right, we're going to talk about all the stuff you're going to have to do now, especially if you've already taken venture and you know your venture fund, unlike your rich uncle, doesn't have more money to give to you, so you're going to have to go out and find it from somebody else. I'm not going to get into that now. We're running out of time, but I do want to do one last thing. What if you get two term sheets? Here's two term sheets. Let's compare these two term sheets. We don't have time to do it, but this is the kind of analysis you're going to go through. Put them up side by side. What are we going to do here? We're going to do math. We're going to do numbers. We're going to do what ifs. That's how we're going to compare these term sheets. You get your crystal ball out. Tell me what you think is going to happen down the road. And that's how we're going to figure out which term sheet's better. And on top of this, I'm not going to say it again because I harped on it a lot last month. On top of that, you're going to compare investors. Make sure you're with an investor that has a good reputation, you know, not litigious, but also not difficult. And you know, people get reputations, just like founders and companies get reputations. Investors do too. Know what you're getting into before you even get to term sheet stage. And once you do, set it up and model it. All right, I was going to talk about exits. We'll talk about that in June. These are successful exit issues. So instead, I'm going to open it up to questions. First, I want to go back to my title slide so you can see my picture. Hold on here. Use the Q&A box for your questions. And let's see what we got here. Oh, okay, so I've got an error on slide 16. It totals more than 100%. Okay, note it. I'll fix the slide, but you get the idea. My email, can you post the email in the chat? Let me do that because I do have a lot of things that I am very happy to share with folks. So I'll go ahead and put my email in the chat. You know, one of you smart tech guys ought to figure out a way to do math inside a PowerPoint, so I don't have to do it on an Excel and then try to import it and finally just give up and use my calculator. All right, that's my email. Okay. Any software you can recommend for cap table modeling? Yeah, there's a lot of them, and I don't want to. Well, let me just tell you who's out there. Of course, everybody knows about Carta. That's one of the big ones. Certent is another one of the big ones. CERTENT. Capture is another one. There's plenty of them out there. And plus, there's good old Excel. Although I don't like keeping Excel spreadsheets because they're always wrong. Okay, what else do we have? All right, well, while you folks are, oh wait, here we got some questions. Okay, if we start with 3 board seats, do you add more as you take more VCs in later stages? Man, by the way, I gotta tell you, it's like 100 degrees in my office right now. I'm not kidding. I moved to Northern California, so I wouldn't have to put up with this kind of weather. It's crazy. First I got sheltering and now I got weather. What's the world coming to? No, you're not going to add more board seats. What you're going to do is you're going to have somebody come off the board. That's why I said be careful when you put your first board together, because I want you to have 3 when you form. I want you to have 1 when you first form a company so we can get documents done. Soon after, if you got co-founders, I want you to have 3 so people have a voice in what you're doing and you have an odd number. Someone just texted me about an air conditioning service. Okay, so I want you to have 3. Well, now you're going to do your VC round, and 2 of those 3 are going to have to come off because you need a VC board member and you need an independent. So go into that with your eyes open, knowing that, and don't put anyone on your board that's going to give you trouble down the road. Okay, here's Cynthia has a question. Says, what is an example of patents? Is it possible to patent an idea? Okay, an example of patents. Well, everybody, let's see where I should put these questions. So, in fact, let me stop sharing so I can talk to you. Okay, so an example of that. So, patents is basically a right to the exclusive use of an invention. And more precisely, you're legally obligated to your own monopoly to exclude other people from using your invention. And it has to meet the standards of patentability. I'm not a patent lawyer. I work with lots of patent lawyers. They're really not so bad. You know, you should talk to one sometimes. Just, you know, drink a lot of coffee. And they'll tell you that it has to be novel, right? It has all these different requirements. You know, it can't be something that's been used in the market by somebody else. It can't be somebody else's art. So, but what it does, and it actually now over the last 10 years, we've had a couple of big changes in patent law. One is that we're on a first to file system. So getting into the Patent and Trademark Office is really important, being the first one there to get priority. And priority means you can stop other people from practicing or using that invention in commerce. The second thing is, what was the second thing? I just looked at my participant list. I lost my train of thought. So, the second thing is you want to be the first one to be there. And the second thing I want to mention about it is that the standards for patentability have gotten a lot tougher. About 10 years ago, we had a big case come along that patent lawyers hated, said it was going to ruin the practice of patent law as we know it. That quite hasn't happened, but software patents are a little tougher now. Business process patents you can't get. There was a time, I'm a tax lawyer, there was a time when you could patent tax ideas. So if I thought up an idea, I mean, that was kind of where it got so ludicrous, right, that the courts had to step in and change the rules. But there was a time I could think up an idea and a tax strategy, something that might save you money. Well, hey, do this. You won't have to pay as much tax next year. And somebody else, if they could think up that same idea, they could stop me from using that idea or telling anybody about it. Does that sound ridiculous? Well, I will show you a cease and desist letter that I have, because that's exactly what happened to me. All right. Well, the law is not such anymore at that point. And I remember talking to the patent lawyer who, about this, and they said, hey, welcome to my world. That's patent law. So it's not quite that way. You can't really patent a business process anymore. It has to be something that can manipulate machinery. But talk to a patent lawyer. Make sure that you do, because if you do have something that's patentable, you want to patent it. If you don't, you'll rely on trade secret. Let's stop on that for a minute. We talked a lot about this last time. We're going to talk a lot about it every time you see me, because it is so important. Trade secret is really valuable to your company. It's the most valuable asset most of my clients have, and the most fragile. It's the easiest one to lose. Why is that? Because you have to meet these requirements. It has to be valuable. Okay, it's valuable. It has to be secret. Okay, so far so good. Number 3, we have to take reasonable measures to keep it secret. And that's where all the litigation starts, right? That's where you see where people screwing up and making mistakes. And so there's a whole process you should go through of procedures to put in place to keep your trade secret and retain their value. But it's still not as good as a patent. In fact, you should have both. You should patent the patentable aspects. You should keep secret the trade secret aspects. By the way, that means making people sign NDAs. It means having exit interviews when people leave. It means coaching them when they come in. Don't bring in, any of that open source. Don't bring in your prior employer's trade secret information. It means having locks and keys and security and strong passwords and all that stuff. And it means documenting, having people keep a notebook and document what they're doing on company time that belongs to the company. All right, don't get me started. What are we going to hear on June 9 that will make switch to shelter in place last more? I'm going to talk to you about personal liability of founders. I'm going to come right out and tell you about troubled company terms. I'm going to tell you about what you should do to protect the company. I'm going to tell you about what to expect. But I just have to tell you how to stay out of trouble personally, right? I don't want anybody going down with the ship, right? You're not a captain out in the Titanic. So if things are not going to go well, we want to make sure we protect you personally so you live to fight another day. By the way, it's not that bad a thing to fail in Silicon Valley. They say fail fast, right? Some people walk around and wear it as a badge of honor. They say, look at all the money I've lost for investors. I really know what I'm doing. I won't make that mistake again. That sounds ridiculous, but it's true. God, if you said that in Japan, you'd have to kill yourself. But here in Silicon Valley, it's a good thing. So much more than being afraid of failing with your company, you should be afraid of personal liability, because that will knock you out of the game for the rest of your life. So I'm going to talk to you about that. That's the thing that might make you afraid to go outside the house, all the bad things that can happen if you're not aware. Can you explain why participating preferred will be more prevalent in post-COVID? Well, yes. All I mean by that is that terms are going to get tougher. And the VCs that I've talked to, the investors, I think they view valuations as having already declined, right? Already declined just because of the market. There's no, I can't quantify it. There's no logic to it. There's still a lot of money out there. You saw the statistics. Companies can still make money if you're in the right business. But I think everyone's expecting a decrease in valuation. Well, sometimes you have to give up something else for that valuation. So what if the company wants to keep the higher valuation? How are they going to motivate the investor to invest when they think it's down here and you think it's up here? We're going to go about it some other ways. Model some participating preferred, and you'll see what I mean. I just think we're going to see more VC. I should say it this way: we're going to see more VC friendly terms going forward. Okay, what else do we got here? Advantages and disadvantages of corporate VC and how to leverage strategic needs. Okay, let's talk about corporate VC. So corporate venture capital, if you're taking money from a venture capitalist, that's what we call a financial investor. They're investing to make money. They want your company to scale, be worth a lot of money. We sell the company, we go public. In my world, we usually do it, exit through a sale, and they get back a multiple of what they invested. And hopefully you're a home run and you improve their RO, their rate of return, internal rate of return on investment. Corporate venture capital isn't quite like that. Corporate venture capital, they're investing in you because you're in the same business and you're a source of supply and you're an acquisition candidate. They want to see how you do. They'll even fund you. And then when you do really well, they're going to have a right to buy you. That's the strategy. That's the corporate venture capital strategy. Or oftentimes corporate venture capital comes with an agreement, a supply agreement, a licensing agreement, something like that. And so how are they? So that's kind of the two different dynamics. How are they different when it comes down to the terms? My experience, anecdotally, is corporate venture, they tend to be less day-to-day operational. You know, they're trusting you to just build the damn thing, and so they can buy you. Not so much, you know, maximize my rate of return and do everything right and fire those people and reduce that salary and stuff like that. So they're not, you know, they're not going to be on your case as much on a day-to-day basis. The flip side of that is that you might not get their attention when you need a vote, or you need them to show up at a meeting, or you need their consent. And that happens to me all the time, and it's just so frustrating, you know. And I've heard people complain about it because they can't get stuff done, especially when corporations keep moving people around, and the guy that believed in you is no longer there, and now somebody who doesn't really care about you is overseeing your investment. The other way it differs, and this is really significant, so that's the good part about corporate venture. Wow, they're going to give me this money and leave me alone, yay. The bad part is they want you on the back end, so they're gonna ask for a right to buy you. That'll take the form either of a right of first refusal. In other words, you can't sell this company to anybody else until you offer it to us. If you do that, you will never sell the company to anybody else, because no one's going to do the due diligence required to decide if they want to buy you if the deal is just going to be taken away. Or they'll want to write a first offer. What's a right of first offer? Well, you know what, you'll offer it to us. If we turn it down, then you can go out to the market and sell the company to someone else. I don't like that either. So what I try to end up with, I might end up there as a compromise, but what I go for is what we call a right of first look. So I'll tell you what, company, we'll give you a chance to make us an offer if you want. And maybe we'll take it, and maybe we won't, but we'll give you the opportunity to make that offer before we go take an offer from someone else. Always negotiate it, so just keep that in mind. That's corporate venture, but the biggest thing is just getting their attention. It's true that patents should be less important as a startup since the focus should be on growth. I'm a believer in patents. I think they're important. You know, yes, the focus is on growth, but okay, keep in mind what a patent does, right? Gives you the right to keep other people from using your invention, but it can also be used, I guess, offensively. That's offensively. It can be used defensively. It gives you some guarantee that somebody else isn't going to come along with a patent and keep you from doing business. So I think they're important. I mean, trade secrets are important. You know, all that stuff is important. I think patents are really important, and investors do like them. Okay, we have a designer who wants to start a company to do better as a designer. I don't quite understand the question. Doesn't look like a legal question to me, but you do hit on one thing. Keep in mind, your company does not have to be technology to be a VC company. It just has to be scalable. And in fact, lately, I don't know why, but I'm working with a lot of fashion companies like the designer. And I think it's because retail is changing so much. And some VCs that I know very well have proven that you can make a hell of a lot of money investing in retail. And I think that's going to be even more true going forward as everything changes and people get used to buying online and buying at storefronts. Okay, well, okay. Jennifer Stoll says I'm looking good. Thank you, Jennifer. Thank you. That is a very fair question. Okay, what terms are negotiable and which a deal breaker? Say if the VC is non-participating, cap and evaluate. Okay, for me, a deal, well, it depends on the company. During normal times, full ratchet is normally a deal breaker. I'm not sure it's going to be true going forward. You might not have a choice. Participating preferred, uncapped participating preferred, during good times might be a deal breaker. It kind of depends on the company. Things that were deal breakers a couple months ago are no longer deal breakers if things get bad. Tune in June 9. We're going to talk about stuff that used to be deal breakers and wasn't. I mean, the standard now, most of the deals I've done have been 1x non-participating, just as watered down as they come, right? No redemption rights. Redemption rights should be a deal breaker, under current conditions. Might not be if you've got no choice but to take the deal. How is it viewed as someone else is infringing a patent? Good question. You're selling, I've seen this happen. We're a company, and we laugh about it when we finally figure it out, that what we're really financing is a lawsuit. It's a strategy, it's a system, it's a game plan, it's a living, I guess it's like being a Shylock or something, but I don't think it's, I don't think it's the best strategy for a VC. Who wants to buy? By the way, there are entities out there that are in business to do nothing but fund lawsuits. So if that's your strategy to get money to sue someone for infringing your patent, don't go to a VC, go to litigation financing. Geez, there's so many questions. I know I'm missing some of them. Thank you, Danielle, sorry, for your comment. Question, given the new conditions, are we going to see VCs investing on wider area rather than in a radius from the valley? So here in my neighborhood in Silicon Valley, we're really spoiled because VCs, we talked about this last time. VCs have, they sit on boards. They can only sit on so many boards, and they don't want to have to get on an airplane, especially now, and have to fly someplace. God, I was on a flight yesterday. I had to wear a mask the whole way. Nobody wants to do that if they don't have to. They don't even want to go to Stockton. So VCs tend to want to invest locally. The question is, well, now that we're doing everything by Zoom anyway, isn't that going to mean they're going to want to invest in my company? I wouldn't be shy about approaching a Silicon Valley VC, even if you're not in Silicon Valley, especially if you're in I do a lot in agriculture technology. If you're an ag tech company, your market's out in the Central Valley or out in the Midwest. So you're going to be there, and they're going to have to invest in a company there, possibly, depending on what you do. So I wouldn't be shy about approaching them because I think that's getting less and less true. I think you're right. Maybe Zoom has something to do with it. Now that I think about it, that you have to be local thing is getting less and less true. And plus, there's VCs popping up in Silicon Valleys around the country and around the world, so you'll find local investors. Best way to contact angels, get a warm introduction. Yeah, you can spam them on LinkedIn, but it doesn't work. Nothing works like a warm introduction, especially from a founder that they've invested in. Is a better chance of making a deal over design related to prevention of COVID-19, or is the market already overwhelmed? That's beyond my pay grade. That's your job to figure out. You just have to show that it's a huge, here's what you got to show. It's a huge market. It's going to stick around for a while, all right? That market's going to be there after COVID is gone and we're all out of sheltering. And then secondly, you're the right team. You're the right team, not that other team. You're the right team. You did something that they can't do. What's a good place to find an investor for my project? For seed funds, yeah, that's more angel stuff. By the way, here's the difference. VCs are not hiding. It's so easy to find VCs. They're advertising. They got websites. We talked last month about angels. They don't really want you to know who they are because you'll be bombarding them with pitch decks, right? VCs, on the other hand, we all know who they are. Anybody can approach a VC. A warm introduction is really valuable, though. Just keep that in mind. What is the most valuable attribute a VC would like to see from a go-to-market strategy, either existing or still planning? The most valuable attribute is that, two things, is that it's a potentially huge market. It doesn't have to be a market that exists today. It's just potentially a huge market. It could be a market we don't even know exists. Who would have known there's a market for masks, right? It has to be potentially huge. And you have to show them a way that you're going to take it, that you're going to get in and you're going to be dominant in it. really quickly before your competitors figure out how to do that. I think that's the most important thing. Okay, hold on here. Now I got some chats here. Let me just go through these. Are there, yeah, rules of the road. A bunch of questions are about taking too much. All right, I know what you guys have been doing. A bunch of questions about taking too much seed capital early on. I don't know that I can give you a rule of the road, and it's really tough with pre-money safes because it's hard to know where you are exactly. I hesitate. I mean, I have an idea. I was going to put a number out, but now that I think about it, I hesitate. I think it depends on the company and who your founding team is, how many people you have, what else is going on in the company, how many inactive founders you might have, how much dry powder you've got left. I think we need to model it. But I can tell you the last one I did where the VC completely walked away from the deal because of this one issue, we had about 40% of the company out. And when we did the math and figured out what the safes would take, they would take about 40% of the company. And the VC said, well, geez, if I leave, 40 for them, 40 for you, that only leaves 20 for me. If I take 40, then it only leaves 20 for you, the founder, and you got to bring on other founders. So it's that sort of analysis, but I hesitate putting numbers on it. What have, okay, wait a minute. Yeah, excessive seed capital. What have you seen? How much time we got? Okay. What have you seen with valuing a growing network if they have no revenue model, but they have 10 million users? Wow. Does it go back to the VC's thought process of how much do I want? How much do they want in terms of valuation? Is there a standard investment value? Yeah, be careful about that. Remember Snapchat when everybody was, figuring out how much Snapchat was worth based on the number of users? It was like $1,000 a user or something like that, so, that just didn't, everybody translated that to their own companies and they thought they were worth a lot more than they were. Again, I can't give you a number per user. And I think it depends on the company, depends on the industry, depends how many other players are out in there, how competitive is it for those extra users. I'm just saying for a lot of venture-backed companies, they would rather have the users because they want growth than the current income. Sorry, I can't give you any good rule of thumb, but I think generalizations are risky. All right, let me go back to, I'm toggling here between questions and chat. Okay, I can self-fund. Should I self-fund or should I take external funding, and where do you draw the line? Oh, and I got a 1-year non-compete. Ouch. Yeah, so here in California, I know I say a lot of bad things about California, like this ridiculous heat that we have in May, but there are some good things. And one good thing we have is non-competes are unenforceable except in connection with the sale of the goodwill of a business. So you can quit your job and go across the street and compete with your prior employer. You cannot take their intellectual property, arguable whether you can solicit their employees, but you can definitely compete, okay? It's not like that in some other states. Back in Minnesota, where I used to practice law, they have some pretty tough laws about non-competes, and they will enforce them. Texas will enforce them. New York will enforce them. California, it's much more friendly to the employee. They want to encourage people moving around. It's one of the things that really built the Silicon Valley, was allowing people to leave and do their own thing. So, so if you're not here and you did sign one of those bad agreements, I don't have a magic bullet for you. Unfortunately, I've seen a lot of good ideas that never made it off the drawing board because of that. I've seen people, locked into what looks like legalized slavery to me because of these things. So all the more reason. I keep telling people all the reasons why they should leave California, but there's a reason why you might want to be here. And it's one of the things that made Silicon Valley grow, I think. Now, you have the option to self-fund. Should I do that or should I take external funding? Again, it depends, and it depends on the company. You need to put enough money into this company of your own to show that you've got skin in the game. You don't put so much money into the company that you're going to do something crazy to keep it alive and preserve your investment. You don't put so much money into the company that you're going to break yourself. Please do not mortgage your house. I've heard other lawyers say, mortgage your house to finance a company. Don't do that. The odds are so much against you. You want to use other people's money if it gets to that point. Please do not draw money out of your 401k. I've seen other lawyers say, yeah, take your 401k money, or take your IRA money. And by the way, you can do that. I've helped people do that a lot with their IRAs. Have IRAs fund companies. It's tricky. It's complex. You got to worry about the tax rules, but it can be done. Who was it? Who made over $1 billion putting their IRA money into PayPal? So it's Roth money, by the way. So it can be done, but don't gamble what you can't lose. Where you draw the line is where you can't afford to lose anymore. At that point, you should be taking other people's money. Find yourself an angel, and then find yourself a VC. Okay, what other? Yeah, Peter Thiel. Thank you. That's who it was. Was it Peter Thiel? All right, you say so. He had a really smart tax lawyer, I guess. All right, let me go through here and see what other questions I've got left. We've got 2 minutes. Oh, here's a good one. I started as a solo founder. Oh, by the way, Jeff Bezos' parents cashed out of an IRA and invested in Amazon. Somebody says, okay, the exception that proves me wrong. For every Jeff Bezos, though, I'll give you 100 people. Tune in on June 9. Tune in on June 9. I'm going to show you the dark side. Unfortunately, I'm a lawyer, so we're all frustrated businessmen because by the way, I've represented, my share of unicorns. So I've seen people go from zero to billions of dollars, and I'm from North Dakota oil country. I've seen people go from zero to hundreds of millions of dollars. But for every one of those, I've seen 100 people lose everything. So tune in on June 9. I'm going to give you the flip side. Somebody wants to be my angel. Okay. All right, let's see. Where was it? I start out as a solo founder. Can I add additional co-founders later? Yeah, let's talk about that. And I'm gonna tell you something that nobody else is going to tell you. I know I'm on the other side of this issue over and over again and again. The answer is yes, but there are going to be economic or tax consequences to doing that. Now, here in Silicon Valley, people go way out on a limb and will take extreme positions on the value of their company. So when somebody gets stock for services, the value of that stock they're getting for the services is taxable income. There's an exception under Code Section 351 that we get around when we form the company. So we've got some leeway at the front. A year later, though, typically you won't have the metrics to qualify for that tax exemption. So new founder comes along a year later, and you want to either sell them stock at a super cheap price or you want to give them stock. Well, to the extent that the value is more than what they paid for it, they have taxable income. And because they're going to be an officer of the company, you, the company, have a withholding obligation. You should collect it at source. In Silicon Valley and in startup land generally, people take the position that startups are worth almost nothing for a long, long time. There are so many models that are built on that principle. And that's not a problem till it's a problem. It works really great until the IRS challenges it. I want to tell you, I have had the IRS challenge it. I have been in audit. I've been to IRS appeals. I have argued this issue. I know how they think. I know what their view is going to be about it. And I got to tell you, it's going to be much different than the conventional wisdom in Silicon Valley on what you can get away with. Now, having said that, the odds of being challenged on this are just really low. It rarely happens. I can count on 2 fingers the number of times I've seen it in the last 35 years. The real risk is that your later financier is going to come along and say, you guys screwed up your stock price. You've got a potential liability. I'm going to ding your valuation. And even that's kind of unlikely. I mean, these days, even the investors are going to close one eye and look the other way on that issue. But still, I'm not going to be the guy that tells you to do it. I will just tell you what people do in startup land. And like we used to say when I did stuff in Southern California, that's Hollywood. Okay, and with that, we are at 8:30. I want to thank you all for tuning in. A recording of this is going to be available. Email me. I gave you my email address in the chat, and I'll send you my slides. Be sure to tune in on June 9 and then again in July if you want to hear more. All new content for the next 2 months. Thank you very much.